welcome to First Draft Live. It's Friday, June 27th. We're coming to you just 1 week after a major European real estate lender called it quits on the US real estate market. They called America's economic policy poisonous and announced a full exit, a $5 billion property portfolio. Poof, gone. We're thrilled to have so many of you tuning in from across North America and Europe. I'm your host, Mark Bonner, business editor in chief, and I'm coming to you live from New York. On today's episode, where exactly is global capital taking commercial real estate next? Foreign investors are pulling back, portfolio shifts are accelerating, and global players are no longer treating the US as the default landing zone. Sovereign wealth funds are pivoting away from America. And after years of buy the dip, global capital is suddenly getting quite selective, and it's not liking what it sees in the United States. So, what's driving this shift? Is the US losing its edge? Is there still a path forward for foreign capital in the US? Or is America's property market in a new global pecking order? Joining us today to unpack it all, Tom Taylor, Senior Research Manager at Trepp. Tom brings nearly a decade of experience across underwriting, asset management, origination, and market research. At Trepp, he leads the charge on real estate analytics and insights, powering everything from his fantastic rundown newsletter and Trepwire. Tom, welcome to the show. I know you're joining us from New York.
Yes, sir. Great to be here with you, Mark. Very excited.
Awesome. So let's jump on in. Table stakes. We've seen sweeping headlines about foreign capital pulling back, but the details are pretty murky. Latin American groups remain active. Middle Eastern sovereigns are still hunting industrial, and not every region is exiting at the same pace. So, Tom, who's still buying?
So, Mark, we've seen across all the different coverage, people are trying to make sense as you're describing of who is stopping, who's starting, who's pulling back. And I think the word that keeps coming to mind is caution, is selectiveness versus retreat as a whole. I think that the Canadian pension funds, the Middle East sovereigns, as you mentioned, Singaporean sovereigns like GIC, some Japanese REITs and sovereign managers, the Norges Bank out of Norway, Australian super funds, and many big playing family offices have maintained and even about to increase their U.S. investments. There's been some big deals lately. We've definitely seen some retreating capital out of China. There's lots of capital controls there that are obviously being imposed to give them some leverage in the ongoing trade war, even though we've seen some positive developments in the last day or two out of an announcement from our Commerce Secretary. We've seen obviously some caution out of Germany, very, very long-term, very cautious investing thesis, mostly out of those financial institutions. So it wasn't a tremendous surprise to see one of their largest CRE investors and lenders start the pullback. And then some Gulf and Asian funds have, across the board, been more selective with their allocations. But when you flip over the table and try to start, implementing, some trade war policies, I think that are more interested in making it easier to sell cars in mainland Europe and throughout Asia versus attracting commercial or discouraging commercial real estate investment in the U.S. You're going to see some change in policy, but overall, we're definitely still seeing a lot of buying activity, and we've got some pretty good examples of that so far this year.
So, which countries or capital pools are actually in retreat, and which ones are still active here?
So the ones that are still active, I mean, we saw a Japanese Mori Trust take a large stake in One Vanderbilt at the end of last year. We think, Japan has received, generally speaking, favorable treatment from the U.S. They seem to still be very interested in allocating to LP funds, to taking big stakes in trophy assets. We saw Norges Bank, so Norway and kind of Northern European funds that have really stayed out of the sights, as it were, of the President Trump's trade war. Took a big stake in a mostly West Coast 48 building logistics portfolio earlier this year. We've seen the UAE announce a lot of data center funds, about 20 billion in U.S. investments that have been promised. And then Singapore's GIC is obviously one of the largest foreign investors in the U.S. They've been very strong, but again, the German and the Chinese funds are definitely taking a step back on the other side of the spectrum.
Look, and as you well know, foreign direct investment in the U.S., in particular to the commercial real estate markets, it's fallen in 2025 to its lowest Q1 level since 2022. At the same time, the dollar's down nearly 10% year to date. The White House has been hammering China and other countries on tariffs, although with China specifically this morning, perhaps there's a little bit of a headwind to solve that. When you combine all of that with 5% base rates, it's a cocktail that global capital doesn't want to drink anymore. What's happened here? I mean, what do you think is the single biggest policy or macro trigger that's been pushing sentiment away from US real estate this year?
So I've got two thoughts on that, and I'm glad you mentioned the dollar because I think that is the overlooked element to a lot of these investment decisions. The value of the US dollar declining about 10% on year to date across a basket of other major other major global currencies is a very underrated element of these investment decisions. That means that sovereign wealth funds, other large asset allocators throughout the world have to increase their hedging costs by, on average, 2 to 3% for a move like that. It's parking your capital in US dollars has historically been a fantastic investment. That doesn't necessarily have to change, but it does become more expensive, and every couple of percentage points does take some returns off of the back end of a deal. Now, the policy that I think is the most impactful, even though it didn't end up being a part of whatever the final big beautiful bill is going to be, is Section 899. The threat of that policy is almost impossible to quantify. And again, while I do believe that the intent of that policy is probably more about decreasing costs for US vendors to sell goods and services throughout the world, it definitely had a chilling effect on investment in the US. And we've already seen, I think a lot of pullback specifically due to the uncertainty, which is also the big word of the year, that threat has caused.
Right. That's the so-called revenge tax, which was stripped from the budget yesterday after pushback from real estate lobbying groups and global allies within the G7. And what you're talking about is that even though it's not out there anymore, and now been stripped from the one big beautiful bill, are you saying, Tom, that that kept foreign capital out of the US even before it came into effect? And does it further chill capital in inbound foreign capital flows because of that threat? Basically, bottom line is that US policy is uncertain and that it carries risk. Are you saying that that'll still have an effect?
I think that it'll definitely lead to more friction. I mean, there is a very universal truism that capital goes where it's treated the best. Historically, that has been United States markets. There was about 10 years ago, I was just talking to the editor of our publication, Commercial Real Estate Direct at Trepp. He mentioned that about 10 years ago, RioCan, one of the largest and oldest REITs in Canada, announced that they were going to allocate more capital to US retail investments because there simply wasn't enough in Canada. The US is a huge market of real assets, of secondary markets that allow more liquidity, and many institutional investors, and whether they be pension funds, whether they be sovereign wealth funds or other asset managers, simply don't have enough places to go find yield. So the US has always been a source for that. The US has also been very favorable in terms of capital treatment. When those dynamics change, when there is more friction applied, that's going to lead to more conversations in investment committees in those rooms. I don't think that the calculus has changed permanently, in that even if you increase the cost of capital to enter foreign dollars into the US, even if there's a bit more uncertainty about how long the hold period is going to be, it's probably still a better investment to park your dollars in US trophy assets or US CMBS than in many of these markets. But at a certain point, that will break, and that will lead to slower decisions, and then more of the cautious investors simply choosing to exit, like PBB.
Right. I mean, and look, while some equity might be pausing, right? Some foreign banks, Deutsche, UBS, Barclays, they remain quite active in CMBS, as we were talking about earlier.
Mhm.
From what you're seeing, how are these banks behaving right now on those lines?
I'm glad you brought that up, Mark. I mean, it's a really interesting development so far this year. So far in the U.S. CMBS market, we've seen over $62 billion of issuance, and last year we got up to about 108 billion. So even though there was a period during March and April and May when issuance really slowed down as a result of upheaval in markets and the announcement of trade war policies that really caused a lot of, especially US capital, to sit on the sidelines, we've seen a large amount of deals getting done. Now, I went ahead and looked into Trepp's new issuance database and broke out foreign book runners, like the banks you mentioned, versus all book runners. And the composition is very interesting. Now, generally speaking, for those who aren't CMBS, specific folks, there's two different major kinds of commercial mortgage-backed security issuance. You've got your conduit pools, which are what you probably think about when you think of CMBS, diversified pools, 50 to 100 loans, up to about $1 billion. And the point of these is to give, investors some topical and broad exposure to different regions and different property types. Now, one would expect European banks, especially, to be focusing on trophy assets during this time and a flight to quality. That would be SASB, or single asset, single borrower issuance, which has actually represented the majority of the overall new issuance pool. The overall, SASB composition versus conduit has been about 75-25 so far this year. So we've seen lots of trophy assets like Rockefeller Center, where Trepp's offices are located, be securitized. Things like One Vanderbilt, things like the Ala Moana Resort in Hawaii, multi-billion-dollar deals. However, if you look at the European banks and that are book running these deals, they're actually doing over 2/3 of their issuance in the conduit space, which is kind of surprising. If you break that down further by the property type mix for CRE, some of it's surprising and some of it's not. I think the largest property type is over 1/3 of the conduit pools have been multifamily. So still a lot of allocation to U.S. apartment projects. Just under 30% is retail, and just short of 25% is the other category, which mostly includes data centers. So you notice that there was almost no office and almost no industrial or hotels in there. I think that's very thematically on point, but it was kind of refreshing to see European banks allocating and offering, to their investors, which can include U.S. and other foreign entities, exposure to U.S. multifamily markets, data center markets, and not just the trophy assets.
We had Mark Rose, CEO of Avison Young, on the show a few last week actually, and he was saying that despite all of this quote unquote negative energy that's out there, from the White House or from the tariffs or anything else, that America is still the biggest sandbox in the world,
Right.
right? So do you think it's just that we've gotten into a moment where it's a little bit harder for foreign capital to punch through? They're a little bit more cautious, but that they're going to do it anyway because America is so big. And just when you zoom out and for historical purposes, that it has been so reliable.
Absolutely, Mark. I think you put it very well. When you zoom out and you look at the whole picture, there are asset managers who need to park capital somewhere. You can't buy gold bars and bury them in the backyard, right? So where are you going to look if you have a mandate to allocate to real estate assets? I mean, there are other markets throughout the world, but the capital treatment in those countries, even with these US developments, is usually even worse. And if you look at the macro environment within the US, I think that, I think you put it very well. It's harder. Doesn't mean it's impossible. And the folks who are making the investment decisions, right, or packaging securitized commercial real estate investments so that investors can get access to that paper, they're all compensated very well to find solutions to these problems, right? And what we had in the 2022 to 2023 period in the US, when the Fed raised the risk-free rate by 500 basis points within a year, and following the 2020 COVID shock that changed the office paradigm, the retail paradigm, it is absolutely impossible to fully understand the fallout of those two developments in the time that we've had, right? So they're still working their way through the system. We've seen some uptick in distress in the office market. Obviously, our CMBS office rate is currently sitting around 10 or 11%, but that still means 90% or so of the balance of office securitized debt is still making payments, still reaching maturity, and making and securing takeouts to pay down that principal balance. Now, that 10% of delinquent debt, especially 75% of it being due to maturity distress versus current payment distress, means that there's opportunities for investors, right? So I think that, one group's distress is another group's opportunity, and we're seeing really great pockets of opportunity for investments pop up all over the place. Our Chief Product Officer, Lonnie Hendry, just wrote a great report. I encourage everybody to check it out at trepp.com, Research and Insights, where we broke down from our tools different pockets of office property investments throughout the country that have low in place interest rates, low in place debt yields, And for value add investors, we have some older vintages. And for core investors, we have some more recent vintages that are just mostly a capital markets problem. The underlying fundamentals of the market are still pretty strong. We're adjusting to the new paradigm. And I do think that the fundamental return profile for foreign capital, for domestic capital, is still very strong here. I'm unaware of any other markets that offer the opportunities that the United States does, even if the dynamics have shifted a little bit.
Okay, if you're just tuning in, we're tracking the great global capital pivot, why billions are flowing out of the US and into places like London, London office, Euro logistics, into anything but American risk. With us is Tom Taylor, Senior Managing Director at Trepp. Okay, Tom, let's talk about some canaries in the coal mine, right? One of the biggest news stories this week on this front was from PBB, one of Germany's largest real estate lenders. It announced that it's exiting the US entirely and selling a $4.6 billion loan book, calling American economic policy poisonous. Is this just a one-off retreat, or do you think it's the early signal of a broader pullback by other foreign lenders?
So I think it's too soon to tell if this is a signal or if it's just noise. We'll be tracking this very closely, but what I can say is that it's not terribly unexpected, right? There is a general, I suppose, cultural and in the financial sphere of the nation of Germany, a deep conservatism. When you have, like we just described, a change in the sticks and bricks office dynamic, where, in the post-COVID paradigm, the demand for office space, particularly Class B and C office space, which is what I suspect a good portion of their loan portfolio is, that simply does not require or does not have the tenancy base that it once did, and the expectation that folks across the country are going to be in the office 5 days a week. That is an entirely different paradigm to adjust to. Now, there has been a large concentration of exposure to just that kind of CRE investment among these German banks. So not terribly surprising that they would be the first to exit. If you look across U.S. banks, if you look across the different types of balance sheet lenders, they're following a similar pattern there. Um, the slamming the door on the way out and calling the U.S. political environment poisonous, I do think is also telling, because the one thing that foreign investors, have exposure to that U.S. Investors and lenders have a little bit less exposure to are the capital controls, are things like Section 899. So that is an outsized risk. The fundamentals, again, I think are very strong, but there's an added layer of risk if you look at, some of the recent electoral developments in large markets like New York. If you look at the different, downstream effects of federal trade policy. That's something that cannot be ignored. But I don't think it's terribly surprising that a heavily office allocated and conservative investment thesis would be the first to call it quits on a $5 billion portfolio.
Right. And Germany, is going through its own economic and political issues. But to be fair, PBB, while it may be the largest of recent time to pull out, they're far from alone. Tom, where does this begin to show up in the data?
Yeah, so I think we track at Trepp a bunch of different data sets in the securitized realm, and we're also trying to make more progress in the balance sheet realm. We track loan spreads. We track a consortium of about 20 regional and larger banks, constituting about $200 billion of current outstanding balance called TALR, Trepp's Anonymized Loan Level Repository. And what we found is that as opposed to securitized lenders, which are very reactive to both the needs of their borrowers and the needs of note buyers on the other end of the market, banks are not incentivized to get dollars out the door in the same way. They don't necessarily make their fee structures in the same way as securitized lenders. They're incentivized to preserve capital, right? So that fundamental conservatism shows up in a couple of different ways. One, it shows up in a very rapid pullback in originations whenever there's distress brewing in the market, right? So as soon as, again, the Fed began to raise rates, as soon as the cracks began to show in a lot of the office markets that were overbuilt, that had large concentrations of Class B and C space, we saw very, very harsh pullbacks in bank originations. We've seen in the last 2 quarters, those actually tick back up, and I encourage everyone to check out Trepp's latest TALR report from Q1 2025, where we saw originations again begin to reemerge, especially in the multifamily space. And also following the sale of a few different rent regulated multifamily portfolios like Signature Banks that finally kind of cleared off of their books. The other ways that it shows up in the data include things like internal risk ratings. So there's, banks have internal criticisms, they have internal delinquency measures that function a little bit differently than the securitized market. They don't have to report them with the same, level of see-through scrutiny that securitized lenders have to, and servicers in that realm. But that's why we're trying to bring that information to the market. We've seen an increase in criticized loans in office markets like Atlanta and Washington, D.C., where there has not been as much of a return to office mandate in effect. In New York, some sources are now saying that the office visit level is back to almost pre-COVID levels. We do not see the same thing going on in places like Atlanta and places like Washington, D.C. Obviously, the latter.
Okay, we have a little bit of interference here with Tom. Give him a second
Think,
to hopefully come back in. Tom, you just lost you for a second.
oh, apologies. I've got you now.
It's good. Well, I'm going to go to a question from the audience. A
Okay.
compromise was reported today between the G7, the U.S. State Department, and the U.S. Senate. How does that affect your evaluation of the situation?
I mean, that's kind of that's a great development. It's a great development to see the G7, mostly Western European nations and other major economic powers, some of the same members of the UN Security Council, um, to get on the same page about mutual goals, and to allow the free flowing of capital should be the goal. I do think that's the goal of the administration. I do think that they're trying to change some of the priorities of the U.S. capital treatment regime. But that means that the incentives of foreign lenders and investors will be more aligned with US ones if they are working toward a similar goal versus the US kind of enacting a protectionism. I think that is what increases that friction I was talking about, that hesitancy, and uh, impacts their returns negatively. Again, fundamentals on the ground very strong. People shopping, people going to the office, people living in apartment buildings. New supply is pulling back. The values of existing properties are likely to increase in many places. Um, there's a bifurcation very much going on in a lot of these markets. Trophy assets are performing very well. Older stock that has not had investment in recent years is going to either be demolished, repurposed, or sold at heavy discounts, and then hopefully renovated. And if foreign investors and lenders can work in the same direction as American ones, then that's a fantastic development and increases liquidity in the market.
Okay, just looking at the US map here, we're seeing some selective resilience. Data centers, REITs, iOS, cold storage. Meanwhile, coastal condos and highly levered hotels are under pressure. Underwriting across the board is demanding deeper equity. What sectors and cities still pencil today? What does the data
Absolutely.
tell us, Tom?
I think that's a great question, Mark. I think that, I just put together a report trying to look at specifically in the multifamily space. And as I mentioned, our Chief Product Officer, Lonnie, put together one in the office space. We'll have the rest of the property types coming out over the coming weeks. Um, Historically speaking, the gateway cities, meaning New York, LA, San Francisco, have been places to park capital for core, maybe some core plus investors, with the intention of preserving capital. Maybe there's not going to be outsized growth in returns, but generally speaking, those are safe places. The dynamic has shifted where I think that the Midwest, cities like Indianapolis, that have had a lot of really, really organic economic growth, and places like Minneapolis, that have a lot of homegrown businesses, a lot of major corporations headquartered there, a lot of very good jobs, highly educated, high household income demographics, good immigration numbers. Those are places for kind of core and core plus investments. Whereas the gateway cities, they have large segments of this class B and C office space and multifamily that's in need of value add investment. There's a lot of places in the Sun Belt as well that have a tremendous amount of growth in the zero interest rate environment, that now, yes, some syndicators kind of lost their shirts, but for the most part, they bought properties, they renovated them, they raised rents, those rent raises have kind of peaked, but they're still very good value. So I think that, Sunbelt multifamily is a good long-term kind of core plus investment. Midwest, very good core. And then the gateway cities and the office space. So the Pacific regions, Northeast region, the Middle Atlantic region, places like New York, Philadelphia, Chicago, LA, San Francisco are very good opportunities for value add investments.
So, Tom, if you were advising a foreign capital source right now, is it time to sell into the noise, double down on a niche play, or just stay patient and wait this cycle out?
So that's, I mean, I think that it really depends on the size of your institution, your investment strategy. But generally speaking, what I'd say is institutional buyers are probably going to sit on the sidelines. They're going to hold cash. They're going to try to find those core stable investments to preserve capital. They're going to underwrite very conservatively, and that's exactly what I recommend. However, I do think that there's a lot of opportunistic investments right now in those pockets, those combinations of regions and sectors that I was talking about. So I mean, if I was a capital allocator with a value add strategy that has, a belief in my ability to, renovate well, to find good entry points, to rely on very solid data, to price my investments, and to budget, then I'm allocating capital to a lot of the high growth markets, especially kind of the investors that currently own properties that are a bit out over their skis and are going to have trouble refinancing.
Okay. Well, look, Tom, I think that's all the time we have today. I really want to thank you for being here.
It's great to be here with
Um,
Mark.
Thank you. Look, we'll be back with another episode of First Draft Live in 2 weeks, so don't miss out. You can sign up now at biznell.com. You can also find today's episode and all of our past episodes in your favorite podcast app. You can also check out biznell.com. This is First Draft Live. Have a great weekend, y'all.